is to review 10 of the most frequently asked questions about IBC. And when we say IBC, we're talking about infinite banking, or the infinite banking concept, originated by Nelson Nash many years ago. But now, as we like to phrase modern infinite banking, how the current economics have influenced whole life insurance and dividend paying whole life. Then from the 10 questions that we highlight, we want to talk about why IBC is best served by using mutual whole life versus other kinds of permanent life insurance. And this is especially interesting now under the current low interest rate environment that we're in. And then we want to highlight some things about how premiums work, how this relates to base premium and paid up additions. So we're really starting to reveal some secrets, how these policies are designed and the way to use them properly with this strategy. And then from the 10 questions, simplifying some concepts such as the MEC rules, which is a big one. A lot of people have questions about it. Cash value, how the cash value works, how the death benefit works, and how things like policy loans work under current policy design strategies.
Steve, that's great. Thanks for sharing that. And
yes, sir.
A quick synopsis of infinite banking and an overview. There are many other webinars people listening can go check out on the Insurance and Estates website, where we do dive more into infinite banking. But quickly, an infinite banking policy is a uniquely designed, properly structured cash value whole life insurance policy. And it has to be with a participating dividend paying mutual life insurance company. Infinite banking does have other names, such as Bank on Yourself, the 770 or 702J account, cash flow banking, private family banking, etc. It's all infinite banking. What I've seen, though, out in the industry is a lot of advisors might claim they're selling infinite banking or high cash value whole life, but still those policies aren't being structured correctly or with the right companies. So again, we want to make sure that if you set up a policy or have one set up for you, that you're following this criteria and make sure it's correct. And by the time we get through the end of this webinar, most of your questions will be answered. But as we always say, look at your own numbers. We can put those together for you. But when you look at your own numbers, you can really see the light bulb turn on and understand how the policy would work specifically for you and your situation.
Right, Barry. So I'll just point out, people might want to clue in on the properly structured part of this as we go forward. Correct?
Yeah, absolutely. And social proof is really important. A lot of people often will say to me, Steve, Barry, I've never heard of this. Why aren't more people doing this? Well, the fact of the matter is there are a lot of people doing this. It's very, very popular in the world of wealth and business. These companies, these banks that everyone's heard of, use these high cash value permanent insurance policies, but they'll never tell you about it, especially the banks. You see, Wall Street has such a grasp on Americans' retirement portfolios. They want you to invest in 401ks, IRAs, mutual funds, ETFs. They really want your money in the market so that they can earn fees off of your portfolio for the rest of your life. Any money that you put into a whole life policy is money that they're not going to earn fees on. However, it is very popular. And so we would encourage you to continue to learn more and more about it. And you'll see once again that the social proof is there to substantiate that what we're talking about is legitimate, but also very powerful when it comes to the benefits that you get in your own portfolio.
So Barry, there's some terms for that kind of, right? These holdings that banks and big companies have. You might see it out there for those of you listening, COLI or BOLI. These are really portfolios of whole life insurance, and they're using it. If someone's listening, Barry, if they ask the question, why do they use it? I know we're going to touch on the advantages and benefits. Is there a clue in there or why they're using it?
Yeah. Number one, it's a safe bucket of money. It's fully guaranteed. And we're going to get into those guarantees here in a minute. And the acronyms you just mentioned, BOLI and COLI, for those that want to know what those mean, it's bank-owned life insurance or corporate-owned life insurance. It's everywhere. And they do it simply because of the benefits.
Powerful.
So Steve, let's get into the top 10 frequently asked questions about infinite banking.
It's exciting. It's almost like we're on a game show or something.
I know. Here we go. Question number one, how soon can I take out a policy loan?
Barry, when I started learning about infinite banking, this was a huge question, right? Because people think I'm going to put some money into it, the policy, and then I want to take out a policy loan to leverage the money that's in there right away. And that's very common. So what are your thoughts on that?
I will say, contractually speaking, you can take a policy loan in the first year, sometimes even as soon as 30 days after the policy's in force. However, I want to be clear here. My recommendation is that you let the cash value build up for 2, 3, 4 years before you take a loan. And I say that because I encourage people to take loans for other investments, for real estate down payments, to invest in their business. And it may take 2 or 3 years to build up some significant cash value, but contractually, you could do it in the first year. The life insurance companies don't really like that. So I do like to put my recommendation out there. And most people say, yeah, I want to build it up for a few years as well.
Makes sense. Someone might be asking, is there a reason why you might take out a policy loan right away?
This is something I hear often where someone says, look, I'm sitting on some cash right now. I've heard that if I put it in a policy and then take a loan, that money's still working for me in the policy. That is true. But if you think you're going to use your cash to go buy a house or invest in business or buy equipment or buy a car, and you're going to do that fairly quickly, I do recommend just use the cash to do that. Don't put it in the policy. The insurance companies really put a lot of time, effort, and energy and work into getting this money working. If you give it to them and then you turn right around and you take a policy loan 30 or 60 days later, they just frown on it. But what if someone has a financial hardship and they didn't expect an emergency or a hospitalization or something like that? Contractually, they can take a loan in the first year, but I don't recommend it.
Yep, makes sense. Frequently asked question number 2. What is the guaranteed interest rate on infinite banking policies? Big question. Barry, what are your thoughts?
The way it sits today is life insurance whole life policies are calculated using a 4% guarantee. A lot of people think, well, that's what I'm going to absolutely earn. That isn't always true. So let me give you the full formula. It's a 4% guarantee in the calculation of the whole life contract, plus an annual dividend that's paid in addition to that, minus the cost of the insurance. So, Steve, it is possible for someone to earn less than 4% if maybe they're unhealthy or they're older. But for most of my clients that I'm working with throughout the country, they're earning somewhere between 4.5% and 5.5% net tax-free, which is remarkable considering it's a safe bucket of money.
Question number 3. Why do you recommend mutual insurance companies instead of stock companies? This is a big question. We've done full webinars just on this topic alone. However, it's a very common, frequently asked question. So Barry, let's dive in.
Yeah, stock companies and mutual life insurance companies, they simply function differently. A mutual life insurance company has no shareholders. The policy owners are members of the corporation controlling the insurer, and this grants them membership rights. So in other words, as a mutual insurance company policy holder, when the company is profitable every year, we get to participate in those profits. Those dividends come back to us. And a mutual life insurance company does take less risk on their portfolio. A stock company, they're beholden to shareholders like any other corporation and not policyholders. A stock company is investing to appease stockholders like on a quarterly return basis. That's not happening in a mutual company. The mutual company is going to do always what's in the best interest of the policyholders, not trying to appease us like, hey, here's our quarterly return. We want it higher this quarter than it was last quarter. Stock companies tend to take a little more risk on their investments because you're in it as an investor trying to earn a higher return or a higher dividend from a stock company.
Right. For me, the way that I put it in perspective is that if you're an investor or you're familiar with the stock market, if you're a dividend investor, then that's what you care about. You're a shareholder, right? And you care about what kind of dividend you can get. and you care about, and as a company, you're looking at the dividends that you've offered. And when you're thinking about dividends with a mutual, you're really talking about a return on premium to policyholders. So it's more of a policy owner's favorable company, at least in my perspective.
That's correct. And what we see here, obviously, other advantages, those dividends, if done correctly in a properly structured whole life policy, we can have that money growing tax-free. If you're earning a dividend in a stock company, it's taxable.
Right. That goes to other topics we've talked about, right? Continuous compounding growth, which is mentioned in here. The focus of the company being managed for the policyholders. You got these nice aspects and why we tend to favor these mutual companies. All right. Question number 4. Are whole life premiums flexible? You get a lot of this buzz out in the industry about flexible premiums. Barry, I'm wondering if you might have a different perspective on that.
I love that whole life premiums are flexible. So the answer to this is yes, it is true. They are flexible. However, there are 2 myths here, Steve, that I want to debunk. Number one, people think that when they lock into a whole life policy, they're locking in to pay the same premium their entire life until they die. That isn't always true. And 2, there's a myth that the premiums aren't flexible. If you are talking to your local agent about whole life insurance, some of that might be true. I don't recommend using a local agent if you're looking at a true high cash value infinite banking plan. 99% of advisors out there don't know how to structure these policies. So in a properly structured policy, the premium is flexible. And we're going to look at an illustration right now to go over those specific flexible options.
There's a lot of flexibility in how you set up your premiums in terms of for a period of time, and there's a big difference too between base premium and the paid up additions portion of your policy design.
That's correct. In a true high cash value infinite banking policy, we want to keep the base premium, which is what's going towards the whole life insurance, as low as possible. And we want to maximize the cash value growth through what's called a paid up additions rider, or PUA. In this particular policy, Steve, I'm using the example of a healthy 30-year-old female at $1,000 a month or a $12,000 a year premium. Just to be, conservative, a lot of people would be able to do this.
Yep.
If this $12,000 a year were going into a traditional whole life policy, Steve, there would be $0 of cash value in the first year. And it would take a long time for the cash value to be built up, because in a traditional whole life policy that a local agent would set up, or someone that doesn't know what they're doing would set up, they're just going to buy life insurance. They're not going to focus on high cash value growth. They don't understand the paid up additions rider or how to use it. But because we're using that component of a paid up additions rider, notice that in year 1, when that $12,000 premium goes in, the total cash value is over $9,600. So most of that premium immediately is going straight to cash rather than to commissions or to buy a bunch of whole life insurance.
That kind of brings us back just to touch on the policy loan question then too. If somebody had to have one for some reason, emergency or something, you might consider that could be available as a policy.
They could borrow up to 95% of that $9,600.
There you go.
Now, notice that the death benefit here is $648,000. And some people might be thinking, well, I don't need that much death benefit. I don't care about the death benefit. I just want to build cash. What I like to point out is, remember, we want the base premium as low as possible. And in this case, the base premium is only purchasing $193,000 of actual whole life insurance. The remaining death benefit is coming from a term rider that we blend to the policy to keep the insurance costs low. And in any year, Steve, this 30-year-old female could reduce the premium to the minimum of $2,459 a year. So the flexible range, as high as $12,000, as low as $2,459, or she could choose to fund any amount in between, Now I'm showing this at age 61. We're going to come back to this here in a minute, but in any year. So if she wanted to go down to the 2,400 in year 6 or year 10 or 11, that's possible. And then if she wanted to go back up to the 12,000, she has that complete flexibility.
Fantastic. So yes, so there's the flexible premium answer. And you were talking about, or you were going to touch on some myths around flexible premiums too.
Yeah, the other piece of that is, do you have to fund a policy your whole life? No. What I'm showing hypothetically is she funding the policy through the age of 60 at 12,000 a year. And then from age 61 to 65, she decides, I'm only going to put in the minimum, this 2,459 a year. And then at that point, she's going to be done starting at age 66. So Steve, look how amazing this is. She's not putting any more premium into the policy starting at 66 ever. She's put in a total of 372,000, but look at this amazing $1.16 million in tax-free cash value.
She's expedited her cash value growth in the way paid up additions was factored in and keeping the base premium low.
Exactly. So we've dispelled the two myths here. One, does she have premium flexibility? Yes, she does. Two, does she have to pay the premium her whole life? No. We're showing that the premium reduces. We're showing at age 66, she's completely done funding. And Steve, even though she's not putting in any more money, she's still earning a guaranteed rate of return and a dividend. So this cash value continues to grow, even though there's no more premium going in. She could choose later in life, if she wanted to, begin taking this income as a stream of tax-free retirement income. So I do teach clients, this can be your retirement plan, like a 401k or IRA, but in my opinion, it's much better because it's guaranteed, liquid, and tax-free.
So Barry, this question comes up sometimes when they're being given a pitch for other kinds of permanent life insurance, like say an indexed universal life product. And one of the big sales pitch items is flexibility of premiums, right? Do you want to speak to that at all, or sort of compare that to what you're talking about?
Yeah, and we're going to talk about IUL here in a minute, but that is the big thing you hear from most insurance agents or financial advisors, that whole life premiums are not flexible. I've proven right here today that that is not true. But your policy has to be structured correctly if you want the same flexibility that you would have in an IUL. You can have it in a whole life policy as long as the policy is structured correctly.
You can have it. And there's also a part of this that people need to realize, right? The stability of the way that these premiums are set up is highly favorable when you compare, say, another kind of product where if you didn't make your payment. To me, you got to know how these things work. There's also a very positive aspect to how premiums are set up within these whole life policies, correct?
That is correct. And we'll get into more of the details on one of these frequently asked questions.
Gotcha. Question number 5, is my death benefit guaranteed?
And this kind of ties in to what you were just asking partially. We're going to come back to the illustration again. And you notice we've been looking at the non-guaranteed values. The non-guaranteed values include the guarantees, but they also include the dividend. If we scroll up to look at the guarantees, here we go. These numbers are truly guaranteed. We'll notice the total death benefit guaranteed is always guaranteed. So the answer to the question, is my death benefit guaranteed? Absolutely. Matter of fact, whole life insurance is the absolute best way to insure your life, not term insurance, not indexed universal life insurance or some type of universal life. Whole life is the best. The reason whole life is the best, number one, is it's been around almost 200 years. But two, Steve, it is a fully guaranteed product. Even after she stops funding her premiums, the death benefit's still guaranteed, right? You're still seeing guaranteed death benefit here. Mm-hmm. And in the guarantees, this wasn't the question exactly, but notice the cash value numbers are guaranteed as well. They don't include the dividend. So I'm not a big fan of just looking at guaranteed cash values. And partially because the mutual insurance companies that we use, Steve, they've paid dividends every year for over 150 years. So we believe they're going to continue to do that. These guaranteed numbers don't include the dividend. But my point is, even in scrolling down in the guaranteed cash values, you never see a year where you lose money. As a matter of fact, in a whole life contract, it doesn't matter if you're 85 or 90, the guaranteed cash value is always going up. And that can't be said of other types of permanent insurance.
Or anything else for that matter.
Right.
I mean, we get that question a lot when it comes to the different returns, and I'm not going to get into details here, but we've got other webinars that you and I have talked about comparing market base, right? That's a big downside to other kinds of less predictable places to put money.
Yeah. And I've often said life insurance isn't an investment, it's a guaranteed investment. You don't get that in the stock market.
Right. And we've talked a lot, you and I have talked a lot about predictability for people just starting to get familiar. There's a huge aspect to this where you're just creating all this predictability in your wealth building, which is a really important part of any wealth building plan.
Yeah. And then think of the peace of mind that comes with that. Think of the future planning you can do because of those guarantees.
Yep. Frequently asked question number 6. Why use whole life for infinite banking and not IUL, which refers to Index Universal Life?
Yeah, another great segue based on what we've been talking about. Whole life insurance, as I mentioned, has been around almost 200 years. It's fully guaranteed, but here's the big thing. The big difference between whole life and Index Universal Life, and I should say variable universal life or traditional universal life, any universal life policy is this. Whole life insurance has no increasing costs, whereas universal life does. The reason why is because universal life, when it was created, Index Universal Life back in the 80s, it was built on the chassis or framework of annual renewable term insurance. The older a person gets, the cost of the insurance continues to go up. So think about that. If you're paying the same premium and the cost of the insurance is going up, two things are going to happen. The universal life insurance company is either going to ask you for more premium, or two, if you don't pay the higher premium, they're going to get the higher premium from your very own cash value. And I've seen this happen. I've had people come to me that aren't clients of mine, but they want me to fix a problem. And they're coming to me saying, Barry, why is my cash value eroding in my indexed universal life policy? And I have to explain to them because of the increasing insurance costs.
Well, that's just a huge can of worms there. At IND, we've talked a lot about different kinds of index products. The easiest way to educate people about it is, do you want a product where you bear all the risks, which shifts the risk to you, or do you want a product where the insurance company has the risks? And because of the older time-tested approach, and when these companies were originating whole life, it was all about allowing you to allocate your risk to the insurance company, right? And valuing your life a certain way and then allocating the risk. When you're dealing with an index product, and this isn't anything mysterious, you are taking the risk of what the markets are going to be doing. And you're also absorbing like you brought up, Barry, the increase in cost of insurance.
And we buy insurance for protection. We buy insurance to hedge, and we want to put that risk and those problems onto an insurance company. That's what we're paying for. But in an index universal life policy, what if you're planning on great returns in the index for the cash value growth, but the market doesn't perform the way that you had hoped? And that's the second biggest problem that we see in IUL, is when you look at an IUL illustration, the insurance agent is able to put in a rate of return, let's say 6%, 6.5%, 7% returns. And Steve, they'll show those returns consistent every single year. But I asked the question, do you really believe that the index is going to return a 6 to 7% return every single year without having a losing year? And obviously people are telling me, well, no, that's not how the market works. Well, that's what this illustration is showing. It's showing you as if you're never going to lose money. And the market just simply doesn't work that way. So I often will say index universal life policy illustrations, they're just completely unrealistic. They look amazing on paper, but there's no way the market is going to consistently earn those returns. And that's a big problem because you might be looking out 20, 30, 40 years from now and looking at all that cash value. The reality is that money isn't going to be there the way they're showing because they don't factor in the losing years or the down years.
Yeah, Barry, and that was a great point, a number of great points. And this is probably definitely my favorite frequently asked question so far. And there's so many things, you and I did a whole webinar on some of the financial pundits and entertainers out there and some of the criticisms of life insurance in general and whole life. And to me, it's such a hard, subtle thing. So you look at a whole life policy, and when you buy into a whole life policy, you're buying guarantees and predictability, and you got other advantages that we've often talked about. There's a big movement out there when you talk about permanent life insurance to not refer to it as an investment. But look at what index universal and these index products do. They actually refer to the indexes, right?
Exactly.
So they're inducing people to think about it as an investment. When you're buying it, you are buying risk, right? And people just need to be aware of that. We do have whole entire webinars on this topic as well.
Yeah, we just want people to be aware as to why we're using whole life. Nelson Nash, who developed the infinite banking concept in the 80s, very clearly said, we must use whole life. I agree with that wholeheartedly because of the guarantees, because there is no increasing cost of insurance, and we're not tying the cash value to a volatile stock market index. Those things alone make whole life very, very important for the infinite banking concept.
Barry, would you equate it to sort of building your house on the rock versus the sand analogy, the shifting
Great
sand?
analogy. Yeah, we want a solid foundation. Absolutely.
Frequently asked question number 7. How do I pay a policy loan back and determine how it's paid back? If any of you listening have read Nelson Nash's book, there was a lot of material on this, some of which I think has been clarified in the years that followed. We're also in a different environment financially, so all those things I think come into the mix. Barry, what are your thoughts on paying back a policy loan?
And our modern approach to infinite banking, I think, is obviously timely. Nelson wrote that book in the 80s when interest rates were much higher, dividends, even from mutual insurance companies, were higher. Today, we're in a low interest rate environment, but the policies still look amazing. So from this modern approach, what we recommend is paying the loan back at the rate that the insurance company is charging. Currently today, it's 5% with most of the companies that we use. You could pay the loan back at a higher interest rate, let's say 8%, and then that margin between 5 and 8, that 3% spread, could go back into your cash value. Nelson talks about that in Becoming Your Own Banker. However, we don't want that extra cash value to mech the policy. And we're going to talk about the mech here in a minute with another question. But it is possible, potentially, to pay back a higher rate than the 5%. Well, how do you determine how to pay it back? What's so great about these policies, Steve, is you get to decide. The insurance company doesn't force you to pay a specific amount back. They don't force you to pay it back in a specific time frame. It really is the function of you being your own bank. You get to pay it back how you want. So if you decide you want to start paying it back 30 days after you take the loan, just like you would with a regular bank loan, great. But what if you're a real estate investor and you're doing a rehab project and you don't even want to deal with cash flow issues until the real estate property is rehabbed and it's sold, and then you pay the loan back? That might take 9 months, 12 months. Well, don't pay a loan. Take the loan, just let the interest accrue over that 9 to 12 months. Once you sell the rehabbed property, now you can pay the loan off in full. It's very, very flexible as to how you determine how you want to pay the loan back.
Yeah, very great examples. Extreme flexibility for real estate investors, rehabbers, people seeking to renovate and flip properties, things like that. I just want to mention, Barry, you talking about at the time of this recording, low interest rate environment. Well, guess what's not that low? Consumer debt, it's consumer credit. If you try to use your credit card, guess what interest rate is attached to that? It's 19% or whatever it is. If you try to buy an RV, which are super popular right now, if it's used, you're going to spend 6.5 to 8% probably in interest on it. Even though we're in a low interest rate environment, money costs money still. You do get incentives when you buy a new vehicle or these kind of things. But what you're saying is a beautiful point, that if you do a policy loan, it's really what you want to, within reason, how do you want to pay it back? And we do recommend people pay back their policies. And Nelson always recommended that. Treat it like a business, right? But pay it back, and you get to choose, and you have so much flexibility, and you might be able to get extra back into your policy to help continue to increase your cash value. Correct?
That's right. And I recommend people look at their own numbers, which they can meet with me. We can go through that together. And then if they have questions about, hey, I'm looking to use the cash value for this, I want to take a policy loan, what's your recommendation? I can guide them in those steps, whether it's real estate deals, they're business owners, maybe they do have high credit card debt or high lines of credit beyond 5%. That makes all kinds of sense to use a policy loan for, but I want to take it on a case-by-case basis. Don't take what I'm saying here as a blanket statement to think use a policy loan for everything. Nope, that's not what we're saying. There are times it does not make sense to take a policy loan, and we would look at that on a case-by-case basis.
Yep, I love that you touched on business owners too. This is also huge for business owners. Business owners, this can be an asset on the balance sheet. This can create liquidity for business owners because of the advantages of using it and it's being so predictable. This translates into all kinds of different people that may be listening. Medical professionals. We did a whole webinar for doctors and medical professionals who need that liquidity. Other business owners listening, real estate investors. So a lot of exciting applications for just having policy loans available for a lot of different reasons, contingency planning or expansion or all kinds of things.
Yeah, who doesn't want liquidity? It adds so many more favorable options for you now and in the future if you have liquidity.
Well, and even if you needed bank financing for some reason, it's still an asset that you can refer back to. So there's a lot of different ways it adds value.
That's correct.
Frequently asked question number 8. Do I have to fund a whole life policy for my whole life?
It's a very popular question, and we did answer it earlier, but I'll address it very clearly again here. Coming back to our 30-year-old female example, we see that she has the ability to stop funding her policy. In this illustration, I chose age 66, total premium, 0, premium outlay, 0, no more premium going in. So do I have to fund a whole life policy my whole life? The answer to that is no, depending on the type of whole life policy you have. So this may not be true for every whole life policy out there. We're talking specifically about these properly structured high cash value policies. If done correctly, you do not have to fund it your whole life. I'll address something else here too, Steve. If she wanted to stop funding after the 20th year, she could. If she wanted to stop funding after the 10th year, she could. So although I might show a client out there an illustration for funding through the age of 60, I still build in that flexibility that they could stop funding after 10 years, after 15, after 20. That flexible premium option gives them the ability to completely stop putting money into the policy.
And that's something that, Barry, you do as part of your design, correct? So you build in that they would only have to pay through a certain time frame, or how does that work?
Yep, that is right. It's naturally built in. Now, my advice and recommendation is fund a policy as long as you can, which means usually through your working years, through retirement. As you're generating income and revenue, definitely keep funding a policy, because the idea is the more cash you get into a policy, the more tax-free retirement income you're going to have later in life. but that flexibility of stopping premiums is built into the policy. And the client doesn't have to choose when they're going to stop. She could be moving along in, say, year 13 or 14, and we have an annual review, and she says, "Hey, Barry, I've decided, I'm going to have more kids, or I'm going to stop working, or whatever the case might be, and I don't want to fund the policy anymore." That is an option.
Yeah. And now for folks listening now, you can design a policy where they're only paying for 10 or 15 years or whatever. We call that limited pay. And we have a whole webinar on that for those of you who think that that might be an interesting option. Maybe you're 50 and you know you're only going to want to fund for 15 years or something.
That's correct.
Frequently asked question number 9. What is the MEC limit? We get a lot of interesting questions about the MEC, and the MEC stands for Modified Endowment Contract. Barry, what do you have to say about the MEC limit?
The MEC limit is determined by the death benefit. Now, this came about in the 80s through the IRS. Prior to the 80s, you could really overfund a policy quite dramatically. Now, I'm going to exaggerate here, but you'll get the idea, where people were trying to stuff $1 million of cash into a $100,000 death benefit policy. Okay. That's an exaggeration, but that's what was happening. A lot of cash going into these very low death benefits.
Right. But Barry, why did they do that? That actually leads to a great point about life insurance, permanent whole life insurance.
Because of how favorable it is. There's so many benefits that someone can get. And Steve, this MEC limit, although it's a limit, it really is the IRS's stamp of approval on these policies.
Yep. It was just too good, basically, for folks that were able to do that. But the benefits remain. It's just you can't put as much into a policy now and still call it life insurance. Correct?
Yeah. And again, it's been since the 80s that this MEC guideline and rule came out. But even today, you have like the Wall Street Journal still calling these policies the tax shelter of the rich. We want these policies. So based on the total death benefit amount, will determine how much cash can go into the policy. The MEC limit, modified endowment contract, goes through what's called a 7-pay test. Most people are going to fund a policy longer than 7 years. Here's what I do. I design the policy to go right up to the MEC limit, so it's safe, it's within the guideline, and it's tax-free, but we're not going to cross the MEC limit. By going right up to the MEC limit, you actually get the most efficient policy possible day one. Some advisors, they'll leave headroom, they'll want to earn a little higher commission or not max fund as much as they could. I personally believe you want the best policy day one. So we want to really overfund the paid up additions right up to the MEC limit every time, so you're getting the best policy.
All right. Frequently asked question 10. Does the life insurance company keep my cash value when I die? This is one of the big misnomer snafu attack attempts that people kind of try with high cash value life, right? And it's really a misnomer, but I'll let you dive into it, Barry, and I might throw my 2 cents in on this one.
Yeah. And we've talked about these financial entertainers like Dave Ramsey, we're going to name names here, who claim that the life insurance company keeps your cash value. Now, that might be true in a traditional whole life plan, but not in these properly structured high cash value policies. We're going to come back to the illustration again. And I like to do this, Steve, showing real numbers so people can see for themselves that this is a myth. And this myth is not true, that the insurance company keeps your cash value. And here's how I explain it. Remember our 30-year-old female client, she only purchased $193,000 of death benefit in whole life. Okay, there's some term insurance there that has a very low cost to it, but her out-of-pocket cost for whole life is only $193,000 of death benefit. So that's all she ever pays for in whole life. But notice over here, the death benefit isn't staying level. It's growing. And this is what Dave forgets, or I shouldn't even say forgets. This is what Dave doesn't understand.
Hmm.
These policies have a growing death benefit. So we're going to do a little bit of analysis here. If we take 193,000 and we add that to cash value in a given year, let's see what happens. So let's say she passes away early at age 45. Our 193,000 in whole life death benefit that she purchased, plus her 253,000 in cash value, comes to 446,000. So what Dave is saying, if she passes away, she's only going to get, or the family is going to get 193,000. Nope. The family is going to get 1.5 million in death benefit. Let's run it a little longer. Let's say she passes away at 70. We're going to take the same 193,000 in death benefit that she purchased whole life, plus the cash value here, 1,440,000, total 1,635,000. What does her family really get, Steve? 2.8 million. So there's so many benefits that people get. So the question of, does the life insurance company keep my cash value when I die? In these policies, your family is going to get a whole lot more than what you had in cash value.
So let's unpack this for a second, Barry. There's a reason that people let this myth run wild. Do they think they don't, first of all, understand how the death benefit works, right? They don't understand how it grows, and it increases based on the cash value and how they're interlinked. Do they think that you should get the cash value plus the death benefit? And is that where the misnomer is? And you actually are getting that, but they think that maybe you're not. It just seems like it's a very confusing thing for folks.
Yeah, that is it. People believe they're only getting the death benefit, but they want to get the death benefit and the cash value. And what we're really proving and showing here is that the family would get more. Even if she lived till 85, there's 3 million in cash here. If you add the 193,000 to this, let's just call it 3.2 million, there's still almost 4 million now that goes to the family. Our point is, if someone says to me, hey, Barry, I want to get the death benefit and the cash value, I can say, well, what if I could give you even more than that? And that's what we're doing.
I mean, is it fair to say that in a sense, the death benefit is in part being funded by the cash value and increased based upon the cash value?
That is true. Yeah, because the MEC limit's raising every year in these policies. We're overfunding the cash value so heavily. The death benefit does have to grow so that the policy isn't going to MEC.
Right.
That can be then transferred upon death to a family, most of the time tax-free. It depends on the size of someone's estate. But most time, that's a tax-free death benefit going to beneficiaries. So again, if this person at 30 years old starts a policy, funds it through the age of 65, stops at 66, and never did anything with the cash, never took income, never took policy loans, her $372,000 would turn into almost a $4 million death benefit that would go to her beneficiaries tax-free.
And I can just, in my own mind, my opinion, it's almost certain that the people that don't work in this industry and watch these things like you do, Barry, they don't understand how this works.
Hence our webinar today. Yeah.
Yep.
Yeah. Answering these top 10 questions. These are questions, Steve, I get week in and week out. I love to share the answers. We do just phenomenal education through the Insurance and Estates website, through the webinars. We want our clients to be educated. Look at your own numbers as we wrap up here. There are many benefits of a properly structured policy. We haven't had time to go into everything, but we've talked about guarantees. We've talked about liquidity. We've talked about protection. We've talked about tax advantages and tax-free use of money. I would encourage people, if they want to learn more, look at their own numbers. They can click the button below. It will take them to a questionnaire. And if they would like the opportunity to meet, we're happy to do that.
Absolutely. Thank you, Barry. I appreciate our discussions. Again, just to echo Barry, take the next steps you need. You can schedule with that calendar. You can also, if you want to dive into any more of these topics, you can look at the webinars on the website. pretty much everything we talked about. We probably have a separate webinar diving deeper to get you on the road to understanding this, and we're excited to help you do that.